Have you ever pondered on the magnitude of influence the U.S. economy wields on the global stage? Well, it's time to unravel that thought. The United States economy, robust and dynamic, stands as the largest economy in the world. With its vast consumer market, innovative firms, and business-friendly environment, it is a significant engine of global economic growth. The U.S., often dubbed as the world's supermarket, is a major importer of goods and services. Everything from cars to coffee, smartphones to sneakers, a significant portion of the world's goods find their way to American shores. This immense demand for products fuels production lines in factories across the globe, contributing to economic activity and job creation in exporting countries. However, the U.S. economy doesn't just import. It also exports an array of goods and services, from Hollywood movies and technological innovations to agricultural products and financial services. These exports bring in revenue, boost economic growth, and create jobs at home, while also meeting the needs and wants of consumers worldwide. But the U.S. economy's influence doesn't stop at trade. The strength of the U.S. dollar, the world's primary reserve currency, impacts global markets. A strong dollar can make imports cheaper for U.S. consumers, but it can also make U.S. exports more expensive for foreign buyers, affecting trade balances. Moreover, the U.S. economy's health has a direct influence on global investor sentiment. A thriving U.S. economy can instill confidence, encouraging investment in emerging markets and globally. Conversely, an underperforming U.S. economy can lead to caution and risk aversion, potentially triggering capital flight from vulnerable economies. In essence, the United States' economic performance sends ripples across the globe, influencing trade flows, currency values, investment decisions, and ultimately, global economic health. The strength of America's economy reverberates around the world, driving global prosperity. What happens when the giant stumbles? As we've established, the United States economy is an influential force in the global marketplace. But if this economic powerhouse falters, the repercussions are felt far beyond its borders. When the U.S. economy takes a turn for the worse, it's like a stone dropped into a pond. The ripples spread outwards, touching shores near and far. International markets are not immune to these ripples. In fact, they are often the first to feel the tremors. Stock markets in Europe, Asia, and beyond can experience significant downturns, mirroring the struggles of Wall Street. This can lead to a decrease in global investor confidence and an overall slowdown in economic activity. But it's not just the markets that feel the impact. Countries that are heavily reliant on U.S. trade can find themselves in a precarious position when the U.S. economy stumbles. Consider nations that export large amounts of goods to the United States. If American consumers are tightening their belts, demand for these goods may fall, leading to job losses and economic instability in these exporting countries. Similarly, countries that count on American foreign direct investment may find that the flow of capital slows down or even dries up during a U.S. economic downturn. This can hamper development projects, slow down growth, and even lead to recessions in these countries. And then there's the issue of the U.S. dollar. As the world's reserve currency, many global transactions are conducted in dollars. So when the U.S. economy falters and the value of the dollar fluctuates, it can cause havoc in international trade and finance. In short, when the U.S. economy sneezes, the world catches a cold. The interconnectedness of today's global economy means that a downturn in the U.S. can trigger a domino effect across the globe. It's a sobering reminder of the far-reaching impacts of the economic decisions made within the borders of the United States. The downturns in the U.S. economy can trigger a domino effect across the globe. Have you ever wondered why the U.S. dollar holds such a commanding position in the global economy? Allow me to shed some light on this intriguing question. The U.S. dollar's dominance is a byproduct of several key factors. First up, let's talk commodities. You see, most of the world's commodities, from oil to gold, are priced in dollars. This is a tradition that dates back to the mid-20th century, when the United States was the world's undisputed economic powerhouse. Consequently, countries around the globe need to hold substantial reserves of the greenback to pay for these commodities. This dollar-based pricing of commodities brings us to the second factor: fluctuation. The value of the U.S. dollar doesn't stay static. It ebbs and flows based on a myriad of factors, ranging from the health of the U.S. economy to geopolitical events. And these fluctuations aren't confined to the borders of the United States. Far from it. They ripple out across the globe, affecting everything from the price of your morning cup of coffee to the cost of fueling your car. For instance, when the dollar strengthens, commodities become more expensive for countries that don't use the dollar. This can lead to inflation and economic instability in these countries. Conversely, when the dollar weakens, commodities become cheaper for non-dollar countries, potentially boosting their economies. Finally, the dollar's dominance is reinforced by its status as the world's primary reserve currency. Central banks around the globe hold trillions of dollars in reserve. They do this to pay off international debts, stabilize their own currencies, and foster economic confidence. This widespread use of the dollar further solidifies its global standing. In essence, the US dollar is not just a piece of paper. It's a powerful economic tool that, like a puppet master, subtly pulls the strings of the global economy. Its influence extends far beyond American shores, impacting lives and livelihoods worldwide. The US dollar, a key player, casts a long shadow over the global economic landscape. How does the US economic policy influence the world's financial markets? An intriguing question indeed. Let's delve into this. The US, being the world's largest economy, exerts a considerable influence on global financial markets. Its economic policies, from interest rates to trade agreements, can create ripples that travel far beyond its borders. For instance, the Federal Reserve's decisions on interest rates can send shockwaves through the global financial system. When interest rates rise in the US, investors might pull their money out of emerging markets and invest it in the US instead, seeking higher returns. This can lead to economic instability in those emerging markets, affecting their currencies, stock markets, and overall economic health. Similarly, US fiscal policy, which involves government spending and taxation, can also impact the global economy. If the US government decides to increase spending or cut taxes, it can stimulate economic growth domestically, which could, in turn, increase demand for foreign goods and services, boosting other economies in the process. Moreover, the US's stance on international trade is of paramount importance. Trade policies, including tariffs and trade agreements, can reshape global trade patterns. For example, imposing tariffs on imports can protect domestic industries, but may also ignite trade wars, affecting global supply chains and economic stability. Countries often mimic the US in their economic decisions. They look to the US as a benchmark, shaping their monetary and fiscal policies based on the American model. This is because the US's economic performance often sets the tone for the global economy. But it's important to remember that these economic decisions are a double-edged sword. While they can spur global economic growth, they can also cause economic disruptions if not managed effectively. So, to answer our initial question, how does the US economic policy influence the world's financial markets? The answer is profoundly. The decisions made within the US borders have a profound impact on economies far beyond its shores. Can we see this influence in action? Absolutely. Let's dive into some real-world case studies that illustrate the impact of the US economy on other nations. Our first stop is China, the world's second-largest economy. In 2018, when the US embarked on a trade war with China, the repercussions were felt globally. The US imposed tariffs on hundreds of billions of dollars worth of Chinese goods. In retaliation, China did the same. This tit-for-tat tariff war not only strained the US-China economic relationship, but also disturbed global supply chains, leading to economic slowdowns in several countries that are part of these chains. Next, we turn to Mexico, a country with a close economic relationship with the United States. When the US economy experienced a downturn during the Great Recession in 2008, Mexico's economy followed suit. With the US as its largest trading partner, Mexico's economic health is closely tied to that of the US. As demand for goods and services fell in the US, Mexican exports took a hit, and so did their economy. Our third case takes us across the Atlantic to the European Union. The EU is another major trading partner of the US, and changes in US economic policy can have significant effects on the EU economy. For instance, in 2017, the US enacted a major tax overhaul that lowered corporate tax rates. This led to a repatriation of US multinational companies' overseas profits, causing a significant reduction in their investments in the EU. Moving to the Middle East, we see the influence of the US dollar in countries like Iran. The US dollar is the world's primary reserve currency and is used for most international transactions. When the US imposed sanctions on Iran, it restricted the country's access to the dollar. This led to a severe economic crisis in Iran, demonstrating the power of the US dollar in the global economy. Finally, let's discuss the case of Japan, where the country's central bank has often had to adjust its monetary policy in response to decisions made by the US Federal Reserve. For example, when the Fed raises or lowers interest rates, it can cause a ripple effect in global financial markets. In response to these changes, the Bank of Japan may need to adjust its own policies to manage the impact on its economy. These real-world scenarios paint a vivid picture of the U.S. economy's global reach. The influence of the U.S. economy extends far beyond its borders, affecting countries near and far. Whether it's changes in trade policy, fluctuations in the value of the dollar, or shifts in economic trends, the reverberations of the U.S. economy are felt worldwide. From China to Mexico, the European Union to Iran, and Japan to many other nations, the ties that bind these economies to the U.S. are clear indicators of the influence and impact of the U.S. economy. It's an intricate web, a complex dance of decisions and consequences, of policies and their ripple effects. But one thing is clear: when the U.S. economy sneezes, the world catches a cold. These examples underline the importance of understanding the global impact of the U.S. economy. They remind us of the interconnectedness of our world, the delicate balance of economic forces, and the far-reaching effects of decisions made in the corridors of power in Washington, D.C. Remember, the world is watching the U.S. economy. Its health and its decisions, its ups and its downs, they all matter. They influence the global economic landscape, painting a picture of prosperity or penury, growth or stagnation. So as we navigate the complex world of global economics, let's keep our eyes on the U.S. economy. For its ripples reach the farthest corners of our world, shaping economies and influencing decisions. This is the global impact of the U.S. economy. So, why does the U.S. economy matter to the world? There's a lot to unpack here, but the key takeaway is that the U.S. economy plays a pivotal role in shaping the economic landscape globally. Remember, as the largest economy in the world, the United States is a major importer of goods and services. When the U.S. economy is thriving, it fuels growth in economies worldwide. But when it stumbles, the ripple effects can cause downturns in international markets and distress for countries that depend heavily on trade with the U.S. The U.S. dollar's dominance is another significant factor. Many commodities are priced in dollars, meaning fluctuations in the dollar's value can have a broad impact. Whether it's the price of oil, gold, or wheat, changes in the dollar can affect the cost of goods around the globe. And let's not forget about the influence of U.S. economic policies and decisions. Whether it's interest rate adjustments by the Federal Reserve, trade agreements, or fiscal policies, these decisions can sway global financial markets and investor confidence. Countries often look to the U.S. as a barometer when making their own economic choices. From the spread of consumer culture to the sway of tech giants like Amazon and Google, the reach of U.S. economic influence is vast. But this power also comes with responsibility. The livelihoods of people far beyond the U.S. borders can be affected by the health of the U.S. economy. In essence, the U.S. economy is a behemoth of influence, and its strength or weakness can significantly shape the economic landscape for countries around the world. The U.S. economy, a behemoth of influence, continues to shape the world we live in. Thanks for joining us on this exploration, and remember to subscribe for more insights like these.